If you believe markets only reward revenue, AST SpaceMobile is the stock that forces you to price the invisible. While the market is open, ASTS trades around $57 per share, modestly positive on the session, yet the market cap rounds to roughly $21 billion. On the same snapshot, trailing 12-month revenue rounds to roughly $20 million, trailing 12-month net income rounds to roughly negative $300 million, and trailing EPS rounds to roughly negative $1.25. That disconnect is not a mistake. It is the wager investors are paying today for a conversion that has not finished proving itself. Engineering capability into carrier activation, activation into build usage, and build usage into a revenue base large enough to justify a valuation already far ahead of current fundamentals. ASTS SpaceMobile is a U.S. company headquartered in Midland, Texas. Its claim is direct-to-device satellite connectivity, cellular broadband from space delivered directly to everyday unmodified smartphones. Unmodified is the commercial differentiator because traditional satellite connectivity typically required specialized handsets, external antennas, or dedicated terminals, high-friction products that stayed niche. AST's thesis is that if ordinary smartphones can connect using standard cellular spectrum and telecom protocols, mobile network operators, MNOs, can sell satellite coverage as an extension of their existing network footprint. In telecom architecture terms, AST wants to add a supplemental radio access layer in low Earth orbit and integrate it into carrier core networks so standard functions still work: subscriber authentication, roaming behavior, policy and quality of service enforcement, and billing mediation. This is why ASTS trades like a mystery rather than a conventional growth story. In telecom, a demo is not a product. Carrier grade means predictable performance under load, stable integration, regulatory compliance, and operational readiness. Service level agreements, SLAs, define uptime obligations and remedies. Carriers deploy slowly because outages create brand damage and legal exposure. Normally, new network services roll out in phases: limited trials, constrained geographies and user cohorts, conservative performance promises, then gradual expansion after repeated validation. ASTS is priced as if that normal process can compress. Not skipped, but compressed. Yet the evidence for that compression is partly hidden inside confidential carrier integration programs and acceptance testing. The narrative has condensed into a single hinge event: BlueBird 6. On November 21, 2025, AST announced the launch date for BlueBird 6 and described it as the largest commercial communications array ever deployed in low Earth orbit. The planned launch date was December 15, 2025, from India's Satish Dhawan Space Center, subject to weather and technical conditions. AST framed BlueBird 6 as its first next-generation satellite and highlighted a scale jump, a phased array around 2,400 square feet, roughly 3.5 times larger than earlier BlueBird satellites, and up to 10 times the data capacity. A phased array matters because it is the technical bridge between possible and monetizable. It is a grid of antenna elements whose phases can be adjusted to electronically steer and shape beams. In direct-to-smartphone links, beamforming can improve link budget, strengthen connections, and allocate capacity where demand exists. In business terms, stronger and more controllable beams increase the probability that enough users can be served with enough throughput and stability for carriers to package the service and charge for it. If the experience is unreliable, carriers will limit or delay rollout no matter how compelling the vision sounds. But largest array is also a warning, and whenever something is unusual, you should compare it to what is normal. In complex aerospace development, risk is typically reduced through gradual iteration. Deployment mechanisms, thermal behavior, structural dynamics, and pointing stability are proven repeatedly across units and upgrades. Large deployable structures can fail in hard-to-replicate ways: partial deployment, binding hinges, thermal warping, power handling instability, pointing drift. A dramatic scale jump is therefore a double signal. It can indicate maturity and confidence, or it can indicate urgency that increases execution risk. That ambiguity is why BlueBird 6 is a repeatability test, not just a launch milestone. The market's belief has credibility anchors. On September 10, 2022, AST launched BlueWalker 3, a large prototype intended to test direct-to-device connectivity using standard cellular spectrum and everyday smartphones. On April 25, 2023, AST announced a space-based voice call using an unmodified smartphone. Those milestones reduce the probability the thesis is physically impossible, but they do not guarantee commercial scaling. Investors must avoid the trap of extrapolation. A demonstration is evidence of possibility, not proof of industrial cadence, unit economics, or timeline certainty. The decisive word is activation. Activation means the service is integrated into carrier cores, packaged commercially, compliant with regulation, and supported operationally. It implies authentication and roaming flows, billing and charging systems, policy controls, and customer support processes. Normally, carriers require acceptance tests and repeated performance validation before broad rollout, and much of that work is confidential. Confidentiality is normal, but it creates the central investing mystery. Public investors can see commitments, but they cannot see every conversion gate that determines when commitments become recognized revenue. This is why the company's November 10, 2025 business update and third quarter results matter. AST emphasized pro forma liquidity rounded to roughly $3 billion. It referenced a convertible note issuance rounded to roughly $1 billion with a coupon around 2% and a conversion price around $96 per share. Liquidity is time. Convertibles buy time with a lower immediate cost than straight equity, but embed potential dilution if converted. The company is effectively telling investors it has runway to bridge execution risk. In that same update, AST framed commercial momentum. It stated it has agreements with over 50 MNOs, representing around 3 billion subscribers. It cited contracted revenue commitments above $1 billion. It highlighted a 10-year agreement with STC Group and a prepayment rounded to roughly $175 million. It referenced a commercial agreement with Verizon. It reaffirmed second half 2025 revenue guidance rounded to roughly $50 to roughly $75 million. It also described activation intentions, intermittent service in the United States, and planned activations in Canada, Japan, Saudi Arabia, and the United Kingdom in early 2026. Here is the investable uncertainty. In normal enterprise and carrier contracts, commitments usually include conditions, coverage targets, service acceptance tests, performance thresholds, rollout schedules, geographic constraints. Prepayments can be advanced service payments recognized over time or structured deployment funding tied to deliverables. Public investors rarely see these clauses. Therefore, the market must infer how quickly commitments become recognized revenue. That inference might be correct, but it can also be overconfident, and narrative valuations reprice sharply when new details arrive. Manufacturing expansion adds another clue and another risk. On November 25, 2025, AST announced it expanded its manufacturing footprint in Texas and Florida, referencing facilities in Midland, Texas and Homestead, Florida, and describing acceleration of next-generation BlueBird production. Normally, scaling manufacturing after product market fit is proven is conservative. Scaling before revenue is stable is a bet. If correct, it signals a shift toward industrial cadence. If premature, it increases burn and amplifies dilution risk. So what does this mean while ASTS trades around 57 during an open market? It means you are trading a probability distribution around a scheduled hinge. Intraday price has tested the mid-50s as a floor and the upper 50s to around 59 as a ceiling. In an event-driven name, those become practical thresholds. Roughly 56 is a near-term risk boundary. Losing it implies de-risking and can accelerate downside. Roughly 59 is a near-term confirmation boundary. Reclaiming it implies buyers are willing to underwrite the narrative into the next milestone. The analyst consensus snapshot labeling the stock buy with a target near 60 adds psychological gravity and can act as both magnet and cap. Now the closure. ASTS is in its most compressed, brittle narrative phase. It has technical credibility anchors from BlueWalker 3 on September 10th, 2022, and the unmodified smartphone voice call announced on April 25th, 2023. It has framed liquidity around $3 billion and contracted commitments above $1 billion as of November 10th, 2025. It announced manufacturing expansion in late November 2025, and it has scheduled BlueBird 6, its first next-generation satellite with unusually large communications array, for December 15th, 2025. The forward implication is sequential. If BlueBird 6 launches as planned and quickly supports operational proof that carriers can activate and monetize, the mystery collapses into a model. Capacity becomes service, service becomes build usage becomes scaling revenue. If the sequence slips, underperforms, or exposes hidden integration friction, the mystery expands and markets reprice probability before financial statements show the cost. Short-term strategy: treat roughly 56 as the risk boundary and roughly 59 as the confirmation boundary, and size for gap risk. Medium-term strategy: demand coherence between activation milestones, guidance, manufacturing scale-up, and cash usage. Coherence is how commitments become forecasts. Long-term strategy: only underwrite ASTS if you believe it can become a repeatable network layer with industrial cadence. Build, launch, operate, activate, monetize, repeat, because a one-off success cannot justify a platform valuation. AST SpaceMobile is not asking you to believe in a satellite. It is asking you to believe in a conversion public investors cannot fully inspect. Orbital capability into carrier product into build usage, and build usage into revenue big enough to justify roughly $21 billion. Because the triggers and timelines behind that conversion are not fully visible, that conversion remains the fundamental mystery that moves the price. Before we wrap, ValueStir is always listening. If you are tracking a public company, a private company that is nearing a major funding round, or even a coin with a story that does not add up, leave your ticker or name in the comments and tell us what you are seeing. Share the angle that bothers you, the filing that feels off, the partnership announcement that raised your eyebrows, or the timeline that does not quite reconcile. The best leads come from investors who are paying attention when everyone else is scrolling. And to everyone who keeps coming back, who watches to the end, who subscribes, who hits like, who comments, and who shares these episodes outside the platform, thank you. We will bring you sharper analysis, tighter narratives, and better work with every release. This was ValueStir.